Good morning, everyone. As I'm sure you are aware, I posted the results for the midterm on a Blackboard. So you have your midterm grade as well as your quiz grade. So remember, add those two numbers together, and that will give you the total for your grade for midterm number one. Okay.
Excuse me, Professor. I
Yes.
don't see the quiz grade still.
Oh, on CUNY Blackboard.
Yeah, I don't see mine.
Okay. What is your name?
Neither on Hill.
What is your name?
Lysander or Forticaragu. Lysander.
Lysander? Lysander. Okay, let me take a look after class or later today, and I'll let you know.
All
Okay?
right, much appreciated. Thank you.
You're welcome. All right, so for today, now we are going to move forward. We're going to start dealing with partnerships. Remember that for the majority of your accounting studies, we have been dealing primarily with corporations and publicly traded corporations. Oh, Rachel, okay, I see some people. Rachel, can you see your quiz grade or your either grade? All right, so I'll take a look at that, Lysander and Rachel. And yes, Francisco, it should be both really, on McGraw-Hill and on McGraw-Hill and on Blackboard. Have you, who don't see your quiz grade, have you gone to Blackboard? Yeah, Kristen, I have a problem with you. I have to see for some reason. No, if you look at your midterm grade, the quiz grade has not yet been added. Okay, so you'll have to add those two together, and that will give you your adjusted midterm grade. Okay, very odd. All tests are open in McGraw-Hill. All right, so I'll take a look, Kristen, then I'll just, I don't understand how some people see and some people don't. Michelle, I'm sorry, Denise, did you look on McGraw-Hill also? Yeah, and you should see them on both. That's odd. All right, so I'll take a look. I'll take a look and see what's going on. Okay, so Rachel and Lysander, I know you were special problems because you're not seeing either. And then I'll take a look at the rest because it's odd that you're not seeing anything. So sometimes what happens is, well, I'll deal with it. Okay, if you still don't see your grade over the weekend, just email me or text me, and then we can deal with it individually. Okay, but it's odd. And Kristen, I know you're a special case too. I was wondering what was going on, but I'm just going to check with that because I did it late last night when I just did the posting. Okay. All right, so just let's take a step and let's look at what's going on with our phantom stock purchase. Remember, at the beginning of the semester, we purchased one share of Apple stock. Last time we looked, which was last Thursday. Last Thursday, a share of Apple stock at the time we began lessons was trading at $115.52. I looked a few moments ago, and the stock was now trading at $119.83. Okay, so overall, what's going on, if you were looking in the news, you know that real estate, commercial real estate in New York City has had a lot of problems because of the fact that nobody is going to work. A lot of people aren't using their offices or their office space in the city. However, Apple, Amazon, Facebook, they're actually taking over the leases for a lot of companies. Okay, these companies are still growing even within New York City. Okay, so if you look at the New York Times today, they were indicating that. So you see these companies are still thriving. Overall, the stock market took a bit of a surge yesterday, so we saw a little bit of an increase, just riding that wave overall. But again, when you see things like this, the reason I tell you stay up to date with what's going on in the world is that you're all going to be working one day full time. That's the goal. Okay, if these companies are thriving, they're all tech firms. If these companies are thriving, these are the kind of companies you should be looking at. You should be following. Okay, what's going on? All right, for your own personal benefit as well. Okay, so we could see post stock split that the stock is going up in price. It was actually at $123 earlier this week, so it did take a little bit of a dip. That $119 is a little bit below what it had been. Okay, but let's just see. Let's throughout the rest of the semester, we'll be tracking it, and you will be looking at the financial news, okay, to see what's going on in the world. Okay, another thing, anybody know what's going on with COVID internationally? We know how COVID has affected our economy, right? What's happening over in Europe with COVID? Anybody? The rates of COVID are increasing again. Okay, not a good sign. Yeah, not a good sign. All right, so hopefully that won't happen here. The second wave, yes, exactly, Francisco. The second wave, this is what people had really been anticipating. So again, in addition to watching what's going on in the news, what's going on in the financial world, also take care of yourselves. Okay, very important that you wear masks, wash your hands. Again, it's going to have an impact on you personally as well. Okay. All right. So in the past, we have been dealing primarily with publicly traded corporations. Okay. Now, we know that there's 3 different types of business entities that exist in the world. Okay. The first type of business is a sole proprietorship. A sole proprietorship can basically start, you can decide today, you know what, I don't need any type of agreement. I'm going to start a business and I'm going to be the sole person responsible for basically managing and administering all of the business transactions for this firm. Okay, the sole proprietorship is the easiest form of business to start. Okay, and the sole proprietorship is actually the most popular in terms of number. Okay, because it's so easy to form, the sole proprietorship is the most popular form of business in the United States. Okay, in terms of numbers. Okay, because again, each of you can go home and start each of you can start your own sole proprietorship today. So ease of formation is in its favor. Okay, there's some negative attributes to sole proprietorships as well. Okay, but what we're going to focus on today in this chapter is the second form of business. Okay, and those businesses are called partnerships. Okay, now we're going to discuss 3 different types of partnerships. Okay, but I want you to know that partnerships are the least popular form of business. Okay, and basically, why are partnerships the least popular form of business? Basically, because of the liability that attaches to a partnership. Okay, especially a general partnership. And we're going to go over really all of those qualities and what exactly, what the attributes of a partnership are. Okay. And then we know what's the third form of business that we have in the United States. We've been dealing with it in your studies up so far, and that is the corporate form of business. Okay, and again, why is the corporate form of business? The corporate form of business in terms of dollars, okay, in terms of dollar values, the corporate form of business has the most dollar value. Okay, those businesses, and that makes sense because they can get financing from outside parties. We know they can get either debt financing by issuing bonds or equity financing by issuing stock. Okay, so in terms of overall dollar value, the corporation is the most popular form of business. In terms of sheer number of businesses, the sole proprietorship is the most popular. And we're going to talk about and what the least popular form of business, but again, it still exists, okay? And it's still in the business world is the partnership form of business, and that's what we're going to go over today, okay? After we go over partnerships today, I always tell my class that you are now going to understand why you are never going to enter into a partnership. Okay, because of all the legal ramifications and all the legal exposure that you have. Even if you get into a partnership with your best friend, okay, again, there's a high probability for those of you who watch Judge Judy. For any of you watch Judge Judy, what are the most popular cases on Judge Judy? Partnerships and pit bulls. Okay, those are the two most popular types of cases. And here we're going to learn today why a sole proprietorship is in fact so dangerous to enter into. Okay, all right. So what is a legal partnership? All right, from a legal partnership, from a legal perspective, a partnership is when two or more people enter into an agreement to do business together. Okay, from a legal standpoint, partnership. Oh, here, let me just go back. I think I'm ahead one slide. Okay, so a partnership, at least the way we're talking about it initially, a partnership is an unincorporated business owned by two or more partners. Okay, so you must have at least two people or two individuals. Okay, partnerships are the least common form of business, the least preferred form of business, but they're still widely used. Okay, and specifically, you know that there's a lot of partnerships when you're dealing with doctors, lawyers, or public accounting. Okay, and if you look at these three different types of firms, you see that all of these firms are service firms, right? They're all providing services to their customers. Again, they don't want to be sole practitioners, probably because they want to share the costs, right, of running an office, employee support, etc. So they still enter into partnerships. Okay. For our purposes, we are going to talk about three different types of partnerships that do exist. Okay, and partnerships do exist for a lot of small businesses, especially family-owned businesses. Okay, in those instances, you kind of have a little bit of more camaraderie than you would if you have just like two individuals entering into something. So that's why when you have a family, again, not that they don't have issues, okay, but it's easier in a family type of situation. All right, now for accounting purposes, okay, for accounting purposes. Okay, the partnership is a separate legal entity. I'm sorry, is a separate a financial entity. I-N-A-N. Okay. For accounting purposes, a partnership is a separate financial entity. And what does that mean? Partnerships should maintain, sorry about that, partnerships should maintain their own records, okay, their own financial statements, their own recording of financial events, okay? However, okay, under the law, okay, and this is what makes them so viable, okay? Under the law, okay, under the law, the partnership is not a separate legal entity. Okay, so while a partnership should maintain its own books and records, okay, it's not a separate legal entity. Okay, so what does that mean? All right, just like when you have a sole proprietorship, okay, why is it so dangerous? Okay, creditors, okay, can attach your personal assets. Okay, so if a partnership gets into debt, okay, and the partnership does not have enough assets basically to pay off its creditors, and the partnership is winding down, it's going out of business, it goes into bankruptcy, okay, the partner's individual personal assets are not separate. Okay, so what happens is the creditors can attach the personal assets. They can take away, the creditors can take away your home, your car, etc. Okay, so that's why you have to be so careful. Okay, when you have a great idea and you want to enter into a partnership. Okay, at least a general partnership. okay, because you have so much exposure for your personal assets. Okay. All right. So let's move on. All right. So how do we account for partnerships? Okay. For accounting purposes, we are going to say these are the books and records of the partnership. We are going to record all the transactions that basically occur on that for that partnership. But again, remember, under the law, it is not separate from its owners. Okay, and this is what's so dangerous. I want you to just highlight this, okay? Partners in a partnership, the individual partners are jointly and severally liable for the activities of the business. Okay, so what does that mean? That basically means if you go into a partnership with your friend, okay, and basically the partnership goes bust, okay, you're going to file for bankruptcy, all right, because it's not a successful business. What the creditors can do, all right, if one partner has more assets than the other partner, okay, and the one with no assets files for bankruptcy, okay, the creditors can go after the remaining partner or partners who have the assets. Okay, so if you have more assets, you are exposing yourself, okay, when you get involved with a partnership, okay, because the creditors can come after you individually, okay, to settle any of their obligations. And then what are you going to have to do? You're going to then have to try to get some remuneration because you've taken on all the obligations for this partnership. You're going to have to try to now sue the other partners to get back what their responsibility for some of that debt was. But again, if they're bankrupt, okay, they have no assets left. So what happens? You're just basically, you're going to be swamped with all the debt of the partnership. So that's why it is so dangerous. And even if you have the best idea, okay, you remember the failure rate of partnerships is very high. Okay, so again, be careful. Okay, that's why I always tell my class, never enter into a partnership after you learn what they actually entail. Okay, now let's move on. So when a partnership first forms, okay, typically what happens is that the various partners contribute assets to the partnership. Okay, maybe even like a computer, maybe a printer, it could be desks, whatever. They also could be contributing if it's two people who have individual businesses. They were sole proprietorships before. Now they want to form a partnership, okay, to commingle their assets. Once the partners, the individual partners, basically contribute assets to the partnership, okay, now those assets belong jointly to all the partners, okay? So once I contribute my computer to the partnership, a year from now, if the partnership's not going well, we'll dissolve. I contributed this computer. It no longer belongs to me individually. It belongs to all the partners. Okay, so again, something to consider. And again, it keeps coming up when we deal with partnerships. Okay, but unless special provisions are made, okay, in the partnership agreement, okay, each partner has unlimited personal liability for the debts of the partnerships. Okay, so that means, again, that the creditors can go after your own personal assets, okay, in the event of a bankruptcy, okay? And remember, if you're stubborn, you really think you have a great business idea, you really want to go forward with this, you have some support, financial support from other individuals. If you decide, despite my warning, to get involved in a partnership, what you must have, okay, what you must basically prepare is something called a partnership agreement. Okay, it must be documented. If you do not have a partnership agreement, absolutely you are going to end up in court one day. Okay, so at a minimum, okay, if you get involved in a partnership, you know that at least you've laid out in the beginning what you believe, what the intent of the partnership is, and what the responsibility of the individual partners are. Okay, because if you don't have an agreement, okay, when you start to hit, and it doesn't even mean that the partnership is unsuccessful and then you run into problems. The partnership could be end up being very successful. Okay, but then, some of the partners get a little antsy and they feel, you know what, I work harder, I'm entitled to more of the net income. Again, so personal views always come into this. So at a minimum, you must ensure that you have a partnership agreement, which details all the responsibilities, okay, of the individual partners. And it also, in addition to the responsibilities, it's also going to indicate how you are going to allocate the net income and losses. Okay, very, very important. Okay, that in that partnership agreement, you indicate how it's going to be divided among the various partners. Okay, so again, if you do enter into a partnership, try to get some legal consultation, okay, so that you at least have some professional oversight as to what should be included in that agreement. Okay, the less formal it is, the higher the probability you're going to have problems. Okay, now, okay, for those 30 of you who are here today, one extra question that you're going to get on the next midterm exam is, okay, remember that the partnership is not a separate legal entity. Okay, remember, it's not a separate legal entity. So what does that mean? That means the partnership cannot pay income taxes. Okay, a partnership does not file a tax return. Okay, it files an information return with the IRS, all right, which just basically details what its net income was and how it was allocated to the partners. Okay, but what has to happen, and we're going to go over this in detail in a little while, what has to happen at the end of every year, okay, in the partnership's life, is that all the net income must be allocated to the respective partners. Okay, since the partnership does not file a tax return in its own name, all the partners must be allocated all the net income, and that net income must then be included on the individual partners' tax returns. Okay, very important feature. Okay, and we're going to go over how that allocation is actually done. Okay, so again, very important from a legal standpoint, partnerships have limited lives. Okay, and again, that's very different from a corporation. Remember that when a corporation is formed, the assumption is that it's going to go on in perpetuity, it's going to go on forever. Partnerships have limited lives. Okay, again, because it's based on who the partners are. Okay, and if one partner leaves, if another partner comes in, but typically, most partnership agreements do have some type of clause where they say, okay, the fact if one partner leaves or new partner comes in, it's not going to change the partnership. Okay, so again, from a legal standpoint, it has a limited life, but that's usually provided for in the partnership agreement. Okay, so again, something though that should be included then, of course, in the partnership agreement. What happens if one partner wants to leave? This partnership, is it going to continue? What if we want to take on more partners? Okay, that should the original partnership continue? So something that should be addressed in the partnership agreement. Okay. Again, it's only a legal distinction that the partnerships have a limited life. Most partnerships have the continuity of existence, but again, they have to make provisions in the partnership agreement. So if you don't have a partnership agreement, again, you're going to run into issues if you end up in court or if you have any type of financial legal problems. Okay, you have to provide for the fact if you want the partnership to continue in perpetuity. If there's any changes in the partnership base. Okay. Okay, so what you are going to be responsible for, what we're going to study is that there are 3 different types of partnerships that exist. Okay, so 3 different forms of business, 3 different types of partnerships. The most dangerous one, okay, liability-wise and financial-wise, is the general partnership. Okay, and then these 2 other partnerships, a limited partnership and a limited liability partnership, these types of partnerships try to deal with, they try to limit the amount of personal liability that the individual partners have. Okay, so you're responsible for knowing all 3. Okay, and we'll start with the general partnership. Okay, in a general partnership, okay, each partner basically has the same rights and responsibilities as a sole proprietor. Okay, what makes this form of business so dangerous, okay, financially to each individual partner, is something called mutual agency. Okay, what does mutual agency mean? Basically, it means that any partner, okay, once you get involved in a partnership, any partner can legally bind the partnership, okay, by signing a contract in its name. Okay, so let's say you and 2 friends get together, you're going to start some type of partnership. Actually, the winter's coming, so let's start with like a snow removal business. You and 2 of your friends decide, let's start a snow removal business. And you decide, okay, it's the one time you decide, I'm going to go on vacation. You go on vacation, there's a huge snowstorm, okay, and there's a big customer, and your business is not able to remove all the snow from the premises, and therefore employees don't have access to the building. Okay, let's just take an example like that. You come back from vacation and you realize, oh my goodness, one of your partners has bound you into this agreement, and basically the person that you signed a contract with has damages, okay, because their employees couldn't enter the building, etc. You and all the partners, the fact that one of your partners signed the agreement makes you personally responsible as well. Okay, so mutual agency, you are responsible for the acts of the other partners, even if you were unaware of them. Okay, so again, that really increases your liability. Okay, and that also shows you really have to have trust and communication with anybody you decide to enter into a partnership with. Okay, so that's mutual agency. The other thing that makes a partnership so dangerous is the unlimited personal liability clause. Okay, again, if in the event of a bankruptcy, okay, you are personally responsible for the debt of the partnership. Okay, so again, you have unlimited personal liability. All right, so what do you have to remember about a general partnership? Basically, what makes it the reason why it's the least popular form of business is because of the fact that there is mutual agency, and any partner can bind the business, okay, in a contract, and also unlimited personal liability. Okay, if you take those 2 factors together, you can see what your personal exposure is. You're young, okay? You don't want to get caught up in a situation like this where you're going to end up paying off a business debt over the next 10 years of your life. So again, be careful before you go into any business venture. Okay, and again, remember, general partnerships have the same unlimited liability like a sole proprietorship. Okay, the risk is intensified again, okay, because you're held financially responsible for your partner's actions, okay, as well as for your own. Okay, and again, you never want to be in a situation where you have the deep pockets in a partnership. Okay, because again, the creditors are going to go after you as opposed to somebody who has no personal assets. Then you're going to have to try to go after your partner to try to get back any remuneration from them. All right, so very important point. Again, we're contrasting the general partnership to a sole proprietorship, but remember, in terms of overall numbers, Okay, the sole proprietorship is the most popular form of business. And again, why? Because of ease of formation, right? Each of you can decide, I'm going to start my own partnership today. I'm sorry, I'm going to start my own sole proprietorship today. And again, because of the fact that it's just you making all the decisions, okay, and the ease of formation, that is, you can start it today, that's what makes the sole proprietorship so popular. Okay, but again, when you look at the next form of business that we're talking about, the general partnership, realize the financial exposure. Okay, because you're responsible for the acts of the other partners. You see how your personal liability increases so much. Okay, so again, general partnership, people get together, again, realize those two different factors. Okay, mutual liability and unlimited personal liability. All right, that make it so dangerous and that leads it to be the least popular form of business. Okay. All right, so again here, let's take another example because I'm really trying to beat this into your heads. Okay, so assume you and your friend enter into a general partnership. You agree, and again, you agree up front to split your profits and losses 50-50. Okay, so while you're on vacation, you're lying on a beach somewhere, having a wonderful time, your partner commits the partnership to a contract, okay, and you don't have the resources to complete it. Okay, that causes your client to have a financial losses. Okay, and let's say here you end up in court, and the customer sues your firm for $5 million. Okay, and sues your partnership for $5 million. Again, your partner, of course, it always ends up this way. Your partner has few financial resources. They claim bankruptcy. So what happens? The holder of the judgment, your client, can hold you personally liable for the whole $5 million. Okay, the fact that you have that 50-50 agreement, that doesn't mean the creditors have to go after the partners 50-50. They're going to go after the partner that has the deeper pockets, the more assets. Okay, and then what are you going to do? You're going to have to try to go after your partner to get back any remuneration from them. Again, if they file bankruptcy, what does that mean? They have no assets. Okay, so here you really see in this situation what your financial exposure is. Okay, so you have to be really careful before entering into any form of business. Okay, the second form of partnership, and again, there has to be a contract, okay, that in the partnership contracts that indicates, okay, you can't just say after the fact, oh no, this was actually a limited partnership. You must have a written partnership contract if you're going to be entering into a limited partnership. Okay, a limited partnership again tries to limit some of the liability. Okay, it tries to limit some of the personal liability of the partners. All right, so what happens here in a limited partnership, you have two different classes of employees. Okay, you're going to have general partners and you're going to have limited partners. All right, so now what happens, the general, and again, this must be stipulated in a contract. Okay, in this type of agreement, the limited partners, okay, I'm sorry, the general partners are the partners in the business and they have unlimited personal responsibility. Okay, the general partners are basically responsible for all management decisions. Okay, the general partners are responsible for all the management decisions. They basically do the day-to-day running of the business, and basically they're responsible for making the major decisions. Okay, the second class of partners in a limited partnership is the limited partner. Okay, the limited partners are basically just passive investors. Okay, so you have the general partners and you have the limited partners outlined again in a contract. All right, the limited partners are just going to basically contribute assets to the business or cash to the business. Okay, The limited partners, their liability ends, okay, based on the amount of assets they contribute. Okay, so again, the limited partners share in the profits and losses of the business, but they are not able to participate actively. Remember, they're passive investors, they're limited investors, they're contributing money to the business, but they are not making any decisions in the business. And therefore, since they're not making decisions, okay, they are not personally liable. Okay, the maximum amount that basically the limited partners are going to risk, maximum risk that the passive investors are going to make is the amount contributed to the partnership. Okay, the maximum amount that the limited partners can lose is the amount that they contributed to the partnership. Okay, now, and again, what's the risk that the general partners take on? The general partners do take on unlimited liability. Okay, they do take on unlimited liability, and they are basically running the business. Now, how does this typically, who's going to agree, okay, to basically have unlimited liability? Typically what happens is that the general partners in the business are not going to have a lot of personal assets. Okay, they're not going to have a lot on the line. Okay, and they're going to be the ones who are working the business day to day, making all the decisions. Then you have a layer of limited partners. They're going to be the investors in the business. Okay, typically what's happened in the past is when you had a limited type of partnership, it was usually for some type of high risk ventures, right? But why else would you get involved in this? It's going to be a high risk type of venture, okay? And again, it's going to be like oil development. Okay, you go out and you try to develop oil fields, commercial real estate, which is also high risk, mining. Okay, those are typically the type of the businesses that limited partnerships basically are involved in. They're high risk, okay, but there's a potential for high reward as well. Okay, so here you set up a tier of general partners, okay, typically don't have a lot of personal assets, and the business is basically run on the contributions that the limited partners make. Again, the limited partners have to ensure that it's very clear they're not involved in the running of the business. Okay, and here again, limited partnerships are not as popular as they once were. Okay, because again, this was basically a way that a lot of people of high net worth were able to get large amounts of write-offs, right, for some of their taxes that were due. Okay, so now limited partnerships, again, because of government and IRS involvement, are not as popular as they used to be. Okay, because they were basically a lot of tax shelters for the wealthy, but again, they do exist. Okay. All right, that's the second type of partnership, a limited partnership. Okay, again, and that's one that has the two different types of partners. All right, and the third and last type of partnership that you're responsible for knowing is a limited liability partnership. Okay, now a limited liability partnership you see a lot more often. Okay, typically here when you look at a limited liability partnership, that's basically when you look at doctors' offices, law firms, law firms, CPA firms. You know, a lot of CPA firms are huge partnerships. Okay, Now, what happened is that the government didn't want to limit, okay, the possibility that these personal service firms don't have the ability to basically operate as partnerships. Okay, so this type of partnership was developed. Again, there must be a contract. Okay, you can't go to court and say, oh no, we meant it to be a limited liability partnership. There must be a partnership contract that exists, okay, which stipulates what the intent and all the partners and their responsibilities are. Okay, in this type of partnership, each partner has unlimited personal liability. So you still have that whole unlimited personal liability problem. Okay, but you're only responsible for your own professional activities. Okay, so let's say you're a dentist. Okay, in your group, you're working. I don't know why I always pick on dentist. You're working in a dental partnership. It's a bunch of dentists. Okay, and one of your partners is going to get sued because of the fact that they did a bad root canal job. Okay, and one of their patients is suing them. Okay, in a limited liability partnership, you are not responsible for the claims against any of your partners. Okay, you are just responsible for your own professional activities, any claims against you. Okay, so you have the unlimited liability, but only for your own claims. Okay, claims against you. Okay, now, so unlike a limited partnership, all the partnerships, and again, there's no limitation on the participation in management. Okay, in a limited liability partnership, everybody has a right to vote. Okay, everybody has a right to participate in the profits. Okay, you're all equal partners. It's just the fact that you're limiting your personal liability. Okay, and again, this type of business was basically formed to prevent lawsuits, okay, that are going to bankrupt all the innocent parties, right? Because we know basically these type of service firms, a lot of times enter into partnerships to basically save on the costs. They pool some of their costs, like for rent, employees, etc. Okay, so they didn't want these the government didn't want, and IRS didn't want to limit the creation of these type of partnerships, so they created this type of partnership with the limited personal liability, okay, for your own professional activities. Okay, and then what does each of those individual partners, okay, what do each of them do to mitigate the loss of their personal assets? Okay, what does each of the individual partners do so that if somebody sues them, they don't go after their personal assets? What do they have? What do they take out? Okay, so that if they get sued, they don't lose all their their contract. But what does their contract provide for? Malpractice insurance, right? Yeah, very good, Oscar. Insurance, malpractice insurance, exactly. So you're going to set up a partnership. You're only responsible for your own personal activities. Okay, and then again, you still don't want your patients to go after your personal assets, so you get malpractice insurance. Okay, and again, just to mitigate, always try to limit the amount of exposure to your personal assets. Okay, because that can basically, haunt you for the rest of your life. Okay. All right, so those are the three different types of partnerships. All right, so what are some, now we're going to look at the accounting practices of partnerships. Okay, now, in a lot of respects, the partnership accounting is very similar to the sole proprietorship. Okay, what's the major difference, okay, between the balance sheet of a partnership and the balance sheet of a corporation? Okay, is the fact that partnerships, there's going to be a section that is called partnership equity. Okay, versus owner's equity, okay, for the corporation. All right, that section is now going to be called owner's equity. Okay, another very important point of when you're looking at the financial statements of a partnership is that there are no retained earnings. Okay, retained earnings do not appear. Okay? Retained earnings do not appear on a partnership's balance sheet. And why is that? Because all earnings must be allocated to the individual partners on an annual basis. Okay? So as a result of that, there has to be a capital account established for each and every partner. Okay, and okay, whenever a partner withdraws money, okay, over the course of the year, because again, a partner has a right, okay, to withdraw money from the partnership, a separate drawing account must be maintained for each partner. Okay, and we're going to go over the journal entries for all of these types of transactions. Okay, so partnerships like a sole proprietorship, okay, and this is a very important point. Okay, when we're talking about, all right, when we're looking at a partnership's financial statements, all right, any salaries, okay, very important point, any salaries payable to a partner, any salaries that are payable to a partner are not expenses of the business. Okay, any salaries paid to the partner, to an individual partner, are not an expense of the business. What does that mean? Any salaries that are paid to a partner cannot be deducted on the income statement. Okay, but again, they're not liabilities, but what they are, what has to happen, Christian, good question, every year when payments are made as a salary to the partners, they have to be considered an allocation of net income. Okay, so any salaries paid to the partners, all right, and I'll put this actually in a different color just so you could do it in purple. Okay, and any salaries paid to the partners are considered an allocation of net income. Okay, so again, this makes accounting for a partnership pretty different from what we've been seeing. Okay, so what does that mean? We're going to see in a little while. Okay, remember earlier I said that basically all net income has to be allocated to the individual partners. Okay, we're going to go through the steps of actually doing that for a partnership at the end of every year. Okay, but remember, all right, if the partnership has any accounting personnel, if they have a manager, any other employees, okay, any other employee salaries may be deducted, okay, any other employee salaries may be deducted, any other employee salaries may be deducted as a business expense. Okay, so any other employees who work for the partnership, their salaries can be deducted on the income statement. They are considered a business expense only for the individual partners. Okay, their salaries cannot be considered a business expense. Okay, they're going to be it's going to be considered an allocation of net income, and we're going to see in a moment how we set up that schedule for payments made to the individual partners. Okay. Now, all right, so partnerships like sole proprietorships, no salary expense for the partners can be deducted on the financial statements. But what is a normal activity for the partners? Partners can basically draw down money. Okay, if I contribute $500,000 at the beginning of this particular partnership's life, okay, if I contribute $500,000, I have the right, unless it's limited again, and it should be in the partnership agreement, I can decide to draw down funds anytime I want. Okay, just because I need money, I want to take some money out of the partnership. When a partner basically takes money out of the partnership for their own personal use, okay, what the journal entry is going to be, okay, when amounts paid to partners, basically they're just drawing down of their own funds. What's going to happen is the journal entry at that point is going to be to partner A's drawing account. That will be debited, okay, for the amount of money that they're withdrawing at this time. And then what is the credit going to be to? The credit is going to be to cash. Okay, so partners can draw down, okay, money out of their out of the partnership, okay, and this is always going to be the journal entry, okay, if over the course of the year. Now, which account, okay, at year end, this drawing account is going to be closed, okay? It's a temporary account, okay? So which account do you think that this partner A's drawing account is ultimately going to be closed to at the end of the year? Okay, which capital account? And specifically, which partnership equity account? Yes, very good, Christian. Partner A's equity account. Okay, at the end of the year, partner A's equity account is going to be reduced, okay, for the amount of cash that they withdrew from the partnership. Excellent, very good. Okay. And again, we're going to go over all these journal entries. I just want to hear to give you an overview of what some of these the issues are when you're accounting for a partnership. Okay. All right. So, ta-da! Again, this looks very similar to a retained earnings statement. Here, this is what must be prepared at the end of every year for a partnership. Okay, so this is a statement that's prepared at the end of every year. Okay. What's going to happen here, we have a partnership, Blair and Cross, statement of partners equity for this for the end of this particular year. So here you're always going to start with the balances for the individual partners, and this is going to represent how much they contributed at the beginning of the year. Okay, and this is the total partner equity, I'm sorry, at the beginning of the year. This is now the total partner equity at the beginning of the year. Okay, now what's the next thing that's going to appear at this on this partner equities form is the additional investments. Okay, so if the partners basically contributed any extra money to the partnership, you're going to add that. So here we could see that each of these partners contributed an additional $10,000 over the course of the year. That increased the amount of total partnership equity by $20,000. Okay, then we added the net income. Again, look what happens. There was $60,000 of net income that was generated at over the course of this year. And the partners basically decided in their agreement that they were going to split any net income and net losses evenly. Okay, so that net income was added to each of the partners' equity accounts. Then what you have here, after you have the subtotal, then here we see the drawing accounts. Okay, each of the partners withdrew money over the course of the year. Francisco, if they invest different amounts, would the ownership change? In the percentage, no. Okay, so what happens, and we're going to see that in a moment. Good question, Francisco. What basically happens is when the partnership is formed, the partners determine how much they're going to contribute, and they're also going to decide how much, what percentages they're going to divide the net income over. Okay, and we're going to see in a little while if one partner contributes more capital, okay, than another partner does. There are ways that the partnership can basically reward those partners that contribute more money. Okay, and we'll see that in a little while, because typically what's going to happen is that in the partnership agreement, they will provide that if one partner provides more cash to the partnership, they're going to get a percentage interest, okay, on their contribution. Okay, but again, the fact that one's contributing more, if it's not detailed in a partnership agreement, no, then the amount of the distribution of net income wouldn't necessarily change. Okay, they'd have to amend the partnership agreement. Okay, very good. All right, so what happens here? Always remember the drawing accounts that reduces the amount of each of the respective partners' capital accounts. If they withdrew money over the course of this year, together each of the partners withdrew $40,000 out of the partnership. So what is the ending balance in the partnership account? $176,000 for Blair, $184,000 for Cross, for a total of $360,000. Okay, and again, in this partnership here, it was determined that the $60,000 net income is divided evenly. That's just what the contract provided for. And again, if you don't, okay, in the event that you get involved in a partnership and you don't have a partnership agreement, which none of you are going to do anymore, if you go to court, the court is always going to stipulate that. They're not going to try to recreate, okay, what your intent was. They're just going to say, if you don't have an agreement, it's going to be split evenly among all the partners, or any net income or net loss will be divided evenly over the partners. Okay, and that's just the way the law is going to look at that. Okay, so if your intent is different, again, it must be included in that partnership agreement. Okay. Okay, so now what happens? Remember, a salary to a partner is not considered an expense. Okay, so what has to happen each and every year? Okay, the amount of net income. Okay, and remember, which financial statement do we determine the net income? On the income statement. Okay, whatever the net income is on the income statement annually, okay, or the net loss, if those happen, unfortunately, too, the full amount of the net income or the net loss has to be allocated to the partner's capital account. Okay, the net income or the net loss, okay, that amount ultimately has to equal zero on the partnership's books and records. Okay, and we're going to see how we do that in a minute. And again, how else do the partners' equity accounts change? Any amount that the partners withdraw from the partnership is also going to reduce their partnership equity account. Okay, remember, the partnership maintains no netting. Okay, so the partners then, based on the amount of net income that is allocated to them, the partners must pay personal income taxes on that income. Okay, so what does that mean? That means that, since, remember, I stated that the partnership is not a separate legal entity. Okay. Since the partnership is not a separate legal entity, and Lysandra, how do you calculate the income? Again, it's always in the percentages that is indicated on in the partnership agreement, and we'll see that in a minute. Okay, again, if you don't have a partnership agreement, the net income or the loss is distributed evenly. Okay, if it's distributed, if you want to distribute it to the partners in any other way, it must be included in the partnership agreement. Okay, so again, remember, a partnership is not a separate legal entity. Okay, so a partnership, the individual partnership does not file a tax return. It files an information return, but it does not file a separate tax return. Okay, so since it doesn't file, if it's two partners, it would be 50-50, Lysander. Again, if it's four partners, it's 25-25. It all depends on the number of partners, but it would be evenly. Okay, so remember, partnership doesn't pay any income taxes. All income is going to be allocated to the partners based on however they provide it for, and then the partners have to include that income in their individual tax returns on an annual basis. Okay, and then you can see because of that, that's why a partnership never has retained earnings, because there's no retained earnings in a partnership. It's all allocated to the individual partners. Okay. All right, so each partnership, again, each partnership, especially because of the liability, each partnership needs to prepare a carefully written partnership contract. Okay, guaranteed you're going to end up in court if you don't have a partnership contract. Okay, in that contract, the rights and the responsibilities of all the parties should be spelled out. Again, you're going to also want to deal with the whole thing about the drawing accounts. Okay, you don't want your partner, okay, or your partners that you're in business in to be able to withdraw all of their investments, right? You're going to limit the amount that they can draw down on, okay? And you're also going to indicate how profits should be distributed at a minimum, okay? Again, it should also spell out the responsibilities of the partners, how net income is going to be divided, and the amount of assets that the partners are allowed to withdraw. Okay, you want to limit the amount. Joshua, is it possible to change the terms? Absolutely. Okay, you can change the terms in the original partnership, but why does that always prove to be problematic? You have to get all the partners to agree. Okay, and again, even if it doesn't necessarily have to be that the partnership is unsuccessful, the partnership could be very successful. Okay, but again, if you want to amend that partnership agreement, remember that all partners have to agree to it. Okay, and that's what makes it so tricky to try to go back after the fact. That's why you want to really provide for all of this, okay, at the beginning of the partnership's life. Okay, because it's hard to negotiate changes. Just given human nature, it's hard to negotiate changes once the partnership has been formed. Okay. And the partners can change it themselves. They could change it themselves if they're all, if they're all in agreement. They could change it themselves. Again, it's always good to have some type of legal consultation in these matters, but it doesn't necessarily have to be. If they can deal with it individually and they feel comfortable with it, then hey, they could just do it. But it should be written, okay? Because if it's not written, again, it's hard to really defend that in court if that's where it ends up. Okay, you always have to protect yourself in these type of legal situations. Okay, you're welcome. And again, Joshua, this answers your question. Having a partnership or contract doesn't prevent disputes. Okay, but if you have a contract, at least it gives the court a framework of what you thought the intent was. Okay, this partnership was formed. Okay, so you try to limit the amount of your liability at the time of the formation of the partnership, because it is hard to amend it after the fact. Okay, oh, you're welcome. Partnerships are actually fun. Okay, so, and Francisco, this gets back to your question. Now we know all the net income of a partnership must be allocated to the partners each and every year end. Okay, so again, what happens if one partner works in the partnership and another partner doesn't? Okay, remember, the salary of a partner is not deductible on the income statement. Okay, the salary of a partner is not included in the net income. Okay, but they can get, if you work in the business, your salary can basically be included as an allocation of net income. Okay, and we'll see in a little while how that's done. So if one partner works in the business, the other partner doesn't, or they work different amounts, again, they can be compensated for this by an allocation of the net income. Okay, again, and now Francisco, if one partner invests more capital in the partnership than the other partner, what can they, and again, this also all has to be provided for upfront in the partnership agreement. What can happen is that the partners agree, okay, since we're all investing different amounts of money, we can basically get whatever the beginning balance in the partnership, partnership's capital account is at the beginning of the year. We can basically get a certain percentage of interest, okay, based on the amount of capital that we have. Okay, so the way that you provide for differing amounts of capital contributed is that you basically are going to allocate interest payments when you are allocating the net income of the partnership. Okay, to compensate that one person is basically providing more capital to the firm. What are they going to ask for? Okay, give me interest on the amount of my contribution. Okay, and then finally, what you can provide for, the third part is the third thing that is included in the allocation of income is how the remainder of the income is going to be divided. Okay, Lysander, yes. Lysander, what is your question? Did you have a question? Lysander?
Hello?
Yes, I hear you. Go ahead.
Oh, okay. Yeah, so I know you said that the salary of a partner is not part of the income.
Exactly.
Okay.
So if the
Personal
partner,
services.
exactly, and we're going to see it in a minute, what the journal entries and how we account for that. But always remember, a partner's salary is never going to be deducted as an expense on the income statement, ever.
So,
okay?
so what is the?
It's always going to be considered an allocation of net income, and I'm going to show you how we do that in a minute. Okay. Sure. And then again, once all the net income is allocated to the individual partners, the individual partners have to include that net income in their tax return. Okay, remember, the partnership is not filing a tax return. So each of the partners, based on the amount of income they're allocated, has to include that income. Okay, and again, I know I've been Debbie Downer on partnerships. Remember, there's so much liability, there's so much risk to them. Again, there are many partnerships that are basically doing very well. Okay, remember that even Apple, okay, Apple didn't start out as a corporation. Okay, again, excuse me, Apple started out as a sole proprietorship, right, with Steve Jobs. He had an idea. Okay, then what happened? It developed into a partnership. Okay, because again, he had to develop a prototype for that product. Again, he was a marketing guy. He wasn't a tech guy per se. Okay, once they had a prototype, once they had a history of sales, they had a vision, a marketing plan, investors, etc. That's when this partnership then became a corporation. Okay, so again, there's always going to be basically building blocks. Okay, and many partnerships exist, CPA firms, etc., exist that are very successful. Okay, and again, it all depends on the, but always remember there is a certain amount of risk in any type of partnership. And again, it's because of liability. okay, and the mutual agency. All right. Okay, so let's look at the next slide is the actual accounting. Okay, oh no, okay, a little bit more. Again, the balance sheet of the partnership, again, is more meaningful. Okay, remember that, okay, whenever a partner contributes personal assets to a partnership, those assets no longer belong to the individual partner. Okay, they belong to all the partners individually. Okay, again, personal responsibility for business debt may not extend to all the partners. Okay, so again, let's say in the future, okay, everybody, you're not really sure yet what your job is going to be, what your career is going to be. However, okay, if you, let's say you work for a bank, okay, let's say you're a loan officer for a bank, is it important, and you're considering lending money to this bank, I mean, to this individual. Okay, so this particular partnership comes in and they want to get some type of loan from the bank. Okay, you are a loan officer. Do you think it's important for you to realize what type of partnership you are dealing with? Okay, is it going to make a difference in the decision as to are you going to lend money to this particular partnership? Okay, is it going to be different if it's a limited partnership, a general partnership, or a limited liability partnership? Okay, absolutely. Very good, Francisco. Lysander, yes, absolutely. Okay, because remember that if you have a limited partnership, remember you have two different types of partners. You have the general partners and the limited partners. Okay, so some of the partners may not have personal responsibility, okay, for any of the debt, okay, if they are a limited partner. Okay, so if you're making lending decisions, okay, if you're a supplier and you're going to sell some of your goods on credit, okay, to a partnership, if you are a bank, okay, and you're evaluating the financial statements of a partnership, it is going to make a big difference, okay, and you must know specifically what type of partnership you're dealing with before you're going to extend any credit to it. Okay, so something very important to remember. Okay. Again, okay, so now we're going to leave the actual partnership agreement. Okay, we're going to leave the main part of the chapter, and now we're going to look at the supplemental section, okay, of the chapter. So, okay, and that deals with more of the accounting in a partnership. So now we basically learned the rules. Okay, now we're going to look at how the journal entries, basically what they are when a partnership is formed and when a partnership is doing business. Okay. Okay. Okay, very good. Okay, so let's continue from here. So now we're dealing with the appendix to the chapter, okay? The supplemental topic. Okay, and now we're going to look at the actual journal entries and financial statements of a partnership. Okay, and you're going to see very early that it's very different from a corporation. Okay, so what is the 4 events, okay, that are going to take place in the life of a partnership? And again, these type of things are going to happen continually over the life of the partnership. Okay, at least in the beginning, we're going to have to open the accounts of a partnership. Okay, that's the first step always. And again, you can imagine that when you open the accounts of a new partnership, you know that that's when capital is going to be contributed, right, by those individual partners. Then typically over the course of a partnership's life, you're going to have additional investments of the partners and also withdrawals of cash by the partners as well. okay, how that's going to be accounted for. And then finally, we know that at the end of every year, okay, at the end of each year, okay, the net income for a partnership must be allocated to the individual partners' capital accounts. Okay, so at the end of each year, basically any net income, okay, there's no retained earnings, okay, in a partnership, all income must be allocated annually to the partners, and those partners are responsible for paying the related income taxes on that allocation. Okay, and now remember I was saying how accounting is always building blocks, that you have to basically always rely on what you've learned earlier. Remember in Accounting 101, when you were closing the accounts at year end? Okay, remember that the income statement accounts, okay, have to be closed at year end. And specifically, which accounts on the income statements? We know the revenue account. Sorry, my dog has a cold and he's not doing too well. Sorry for the sound effects. We know the revenues, okay, the revenue accounts must be closed on the income statement. We know that all of the expense accounts must be closed on the income statement. And also now we have a new account that has to be closed annually, okay? It doesn't appear on the income statement, but it must be closed annually, and that's basically the partners' capital accounts. Partners' drawing accounts, sorry. Okay, so these three types of accounts, revenues, expense, and the partners' drawing accounts, must be closed on an annual basis. Okay, they're temporary accounts. All right. All right, so now here we're going to go over how you account for transactions in a partnership. Okay, so on January 1st, 2018, John Blair and Richard Cross, they basically were sole proprietors. They had two different retail stores, and what they decide, they don't want to be sole proprietors anymore. So as of January 1st, what are they going to do? They're going to form a partnership, and they're going to basically contribute the assets to this new partnership. Okay, so when this partnership is formed, okay, these are the journal entries based on the individual partners' contributions. Okay, so on January 1st, we see that Joan Blair, okay, contributes $40,000 worth of cash. So now this is on the balance sheet of the partnership. Okay, these journal entries are now these asset accounts are going to appear on the balance sheet, okay, of the partnership, and these are basically the journal entries on partnerships financial statements. Okay. Okay, so now we have new financial statements that we are preparing. Okay, here Joan Blair contributed $40,000 of cash to the partnership, debited, it's an asset. She also contributed accounts receivable of $60,000, and again, $60,000, and she contributed inventory of $90,000. Okay, she also contributed. Now the partnership had to take on $30,000 of debt. Okay, that reduces the amount of her capital contribution. Here, our debits and credits have to equal. So what is the amount that is going to be credited on the day of formation to her capital account? $160,000. Okay, now what I also want you to remember, okay, that when a partnership is formed, okay, when a partnership is formed, the books are always going to be valued, okay, are always going to be for the fair market value. The fair market value of the assets contributed. Okay, and this is very important. What does it mean? Okay, so these were two sole proprietorships that were basically in business previously. Now they decided to become a partnership. All right. Whatever assets are contributed to this partnership, it doesn't matter what the book value was. Okay, the book value of all of these assets previously does not matter. It's the assets contributed are always going to be recorded at their fair market value. Okay, and remember though that each of the partners has to agree to what the fair market value of these assets are on the date of contribution. Okay. All right, so this is what this is Joan Blair's capital account. That's the journal entry when she contributes assets to the partnership. Now let's look at the other partner, Richard Cross. So on January 1st, Richard Cross contributed $10,000 worth of cash to this business. He contributed inventory that had a fair market value of $60,000 on this day. He contributed land to this partnership, which had, remember, a fair market value. Doesn't matter what the book value was, went under his sole proprietorship. The fair market value of that land on this day was $60,000, and the fair market value of the building contributed was $100,000 on January 1st. Okay, he also contributed some debt to the partnership, which equaled $70,000 in accounts payable. So what is the value of his capital account on this day? $160,000. Okay, now, question, what would be the answer if I asked you, okay, that right after they contributed all of these assets, if I asked you, if I prepared a balance sheet on this day, okay, the balance sheet for the partnership, what would be the amount, okay, of cash that would appear on this partnership's balance sheet after these two transactions are recorded? What is the amount of cash that would appear, okay, on the income statement? Anyone? What's the cash value going to be? Okay, again, remember it's two partners contributing, so the amount of cash in this partnership, oh good, I have some takers, is going to be $50,000. Excellent, Francisco, exactly. They, remember, now they are a partnership, so the amount that they contributed jointly is going to be the amount of cash that is going to be represented. What is the balance? What is the amount of accounts receivable? Okay, after these two, and again, on the partnership's books and records, what is the amount of the accounts receivable? It's going to equal $60,000. Excellent, Oscar. Okay, and then again, let's look at the liabilities. What's the total amount of the accounts payable going to equal? Okay, under the liabilities, the total amount of the accounts payable is going to equal the $100,000, Oscar. Okay, so realize now they're operating as a partnership, so that means any assets, is supposed to be 100,000, sorry, any assets that are going to be contributed now become part of the assets of the partnership. Okay, they no longer belong to the individual partners. So if Richard Cross, okay, at the end of the year decides, you know what, I don't want to be part of this partnership anymore, it's not working out for me, I'm going to take back the land that I contributed, he can't do that, okay, because now each of the partners owns all of these assets jointly. Okay, all right, so this again is always going to be the first journal entry in the life of a partnership. Okay, now what typically happens is that once a partnership has been in business for a while, what do the partners decide to do? They decide, you know what, let's contribute a little additional cash. Okay, our cash position is a little weak, so let's contribute additional cash. Okay, any cash that is contributed by the individual partners is always credited to their respective capital accounts. Okay, so here in total, but each of the partners contributed $10,000. What was the total amount of cash then? $20,000. Okay, $20,000 gets debited. Okay, and what is going to be credited? Each of the individual capital accounts for the partners. $10,000 credit Joan Blair Capital, $10,000 credit to Richard Cross Capital. Okay, and that's for the additional investments. Okay, what they don't talk about here, and what there's not a slide here. Oh wait, I just want to show you. All right. Now, what happens later on? If during the course of the year, Joan Blair decides she wants to, Joan Blair withdraws $24,000 cash. Okay, she decides, you know what, I need some cash from my personal business, so she withdraws $24,000. Whenever a partner withdraws cash from the business, I know I have a question. No, not a debit yet, okay? What they're going to do, okay, is they're going to, whenever they're going to debit their drawing account, it's going to be closed to their capital account, Lysander. But what's going to happen here, the journal entry is going to be Joan Blair, drawing account. And remember, this drawing account is that temporary account. Okay, Joan Blair drawing account, $24,000 is going to be debited. Okay, and you're panicking, you're on the exam. What do you think is going to be credited here? Joan Blair Capital, she's drawing down funds, cash, very good. Okay, always, you know, go back to your journal entries. When you have any questions in life, go back to your journal entries. So here, and she's drawing down $24,000. That account is ultimately at year end going to be closed to her capital account. But right now, when the transaction occurs, this is the way it must be recorded. Okay, it's not going to be a direct debit to the capital account. Why? Because usually when a partner is withdrawing cash, you want to know the detail. Right, you want to know, you don't want to just lose it in terms of just directly reducing the capital account. You want to know what all those drawings were and highlight them over the course of the year. Okay. All right, so realize these two different journal entries, okay? Contributing capital, credit the capital account directly. When they're withdrawing cash, though, you're going to debit the drawing account first. Okay, so it provides that extra layer of detail. All right, so what happens, and again, you're having flashbacks now to Accounting 101. Okay, so here, let's assume that in the first year of operations of this partnership, the partnership earns $60,000 in net income. All right, so again, no partner salaries or anything have been deducted. The net income for a partnership was $60,000. In addition, assume that Blair withdrew $24,000 over the course of the year in cash, and the other Cross withdrew $16,000. Okay, remember this account, the income summary account. Remember that was the clearing account, right? Over the course of the year, all what was closed into the income summary account. Remember all the revenues of the corporation, right, were credited to that income summary account, and all the expenses of the corporation were debited, okay, to that income statement account. In this instance, the revenues were greater than the expenses. Okay, so they had net income of $60,000. These are the closing journal entries at the beginning of this. At the end of the year. These are the closing journal entries. Okay. Since you know that there was net income of $60,000, remember, what do you have to do? Net income must be allocated to the partner's capital accounts. So here, when you're at year end, what has to happen? You're going to debit and basically zero out. Remember, that's a temporary account. Okay, so at year end, you are going to reduce the balance in that account. So here, you're going to debit it for $60,000. And then what are you going to credit? You're going to credit Joan Blair Capital, and you're going to credit the Richard Cross Capital account, increasing them, right? So here they had net income of $60,000. So what are you going to do? You're going to increase the partner's capital accounts at year end for the net income earned. Okay, but what else? What other account is a temporary account? Remember, these drawing accounts are temporary accounts also. And these drawing accounts must be closed at year end. Okay, and what are they closed to? They're closed to the capital accounts. Okay, so Lysandra, here you see where since drawing, when a partner draws down capital, that's a reduction to their capital account. So here, when you're closing the drawing account, remember we debited it last time when we saw for Joan Blair when we created it. When we're closing that drawing account, we're going to debit their capital account for $24,000 Blair, $16,000 Cross, and then here we're going to go close out the drawing account and for both partners. Okay, so at the end of the year, once we do this journal entry, what is the balance in the Joan Blair drawing account? Okay, at year end, after this journal entry, what is the balance in the Joan Blair drawing account? Excellent, Lysander, zero. What's the balance? Zero. What's the balance in the Richard Cross drawing account? Also zero. What's the balance in the income summary account after this journal entry? Zero as well. Very good, Lysander. So here, remember, at year end, we close all of those temporary accounts. So these are always the journal entries that are going to be done at year end. Okay, just realize that this one is going to be a little bit different based on whatever the income distribution that you've decided on. Okay, but remember, you have to close you always have to close the income summary, and you have to close the drawing accounts as well. Okay, good. All right, and you know what? Let's stop at this point, okay? So I'm going to stop at this slide before we get into the detail for accounting. Please, though, over the course of the weekend, please read the last few pages of the chapter. Again, it's very different from what you've seen in the past, okay? This is an easier chapter. Okay, some partnerships are a fun chapter, an easy chapter. You could start doing some of the exercises as well. Then I think the next chapter that we are going to look at after Appendix C, after Appendix C, we have a really tough chapter, the statement of cash flows, okay? So enjoy this chapter, get very proficient in this chapter. All right, and then after that, we're going to go over the tricky chapter, which is the statement of cash flows. And ultimately, the statement of cash flows is the chapter we're going to have the next quiz on as well. Okay, all right, so everybody, you're welcome, Joshua. Stay healthy, stay happy. I'm going to see you next class. I'm going to look at some of those scores. I'm not sure why it's sketchy like that. Okay, if you don't see your scores appearing on Blackboard by Saturday, just give me a text or something. Yeah, I thought I opened the exam, but yes, I'm going to try to do it, Francisco, so you can see the exam, yes. Okay, you're welcome, Jeffrey. Have a good weekend. You do see yours, Joshua, so maybe take a second look. It should be there. Okay, Francisco, okay, you're welcome. All right, everybody have a good weekend. Stay healthy and happy. Remember, COVID rates are going up again. Wash your hands. Don't go out, study accounting. Okay, you're welcome, Christian. Thank you, Francisco, for your participation. Stay healthy, happy. And register to vote are all recorded sessions. Yes, they're all on Black. No, they should all be there. You may have to, you know what you have to do, Oscar? You may have to click on previous sessions. Okay, there's like something at the top. You too, Daniel, at the top where it says previously recorded sessions. Just click on that and they should all be there. Okay. Have a good day. Thank you.